Good afternoon.
Good afternoon, sir.
Sorry for my
We're
late.
going to start in about a minute. Hello, you were saying something, but I couldn't make out what you were saying.
No, I was saying my apologies for being late.
Oh, no problem. Yeah, we'll start in a few seconds.
Okay, sir.
Okay, good evening. Let's get started.
$300 to my bank account and start saving on my other account.
Okay, so let's get started, folks. Okay, everyone can see the screen.
Yes, sir.
Okay. All right, so we ended last class dealing with real estate applications. Real estate appraisals. Sorry. I want us to go back to page 52. The chapter 8 review questions. Chapter 8 review questions. Page 52. And let's okay, question 6. A property valued at $260,000 is being sold for $250,000, and the purchaser is requesting a mortgage loan of $200,000. The bank will value or the $250,000 cost. Which of those two?
In order that you want to say that again, you were in and out just now.
Okay, sorry about that. Okay, be on page 52. Page 52, question 6, which says a property valued at 260,000 is being sold for 250,000, and the purchaser is requesting a mortgage loan of $200,000. So question number 1 on this is, the bank will express the loan amount as a percentage of which of the two value or $250,000 cost?
Sale price,
So the sale price, which is what?
which would be it's being sold for 250,000.
Okay, so your answer would be $250,000. Okay. Because okay. Question number 2. Show the percentage using the standard calculation. So what is 200,000 as a percentage of 250,000?
Okay, let me quickly calculate. Hold on.
Is it 80%, sir?
Okay, 80%. Anyone else gets anything different?
Yes, I got 80% as well.
Okay, so 2 of you got 80%. 80% is correct. Okay, and so that's 80%. And question 3, why would the bank use this calculation? Why would the bank use this calculation? That is using the cost percentage, because we said that it's $250,000.
Because the cost of it becomes the new value. I don't know.
Okay.
Bank
So
will always use the
when you
lending.
say the cost becomes a new value, what do you mean the cost becomes a new value?
Because if you, even though it's appraised for a certain amount, or but the owner decides that they want to sell it for lower than, you will have to go based on what the owner wants to sell it for, or so that then now becomes the value of the home, because I'm trying to find a way to explain
You're
it.
on the right track. You're on the
No,
right
no,
track.
no, for real.
You're on the right track.
Yes, I basically it's thrown on backward, like it doesn't matter anymore. The appraised value of the property or the house, it at that point it doesn't matter anymore. If the owner decides that, hey, I want to sell it for a lower price than what you value it as. I don't know. You could probably explain it better.
Daniel. Oh, Mr. Norwich.
You're fading in and out.
Okay, Mr. Norwich, question. Could it have something to do with risk as well? Seeing that the bank would use, let's say, 80% of what the value is, just to ensure that they protect themselves relatively because of any exposed risk that they might encounter in the future. And I'm straight up guessing right now. Hello?
Yeah, both of you were fading in and out.
Okay,
Both of you were fading in and out.
I was saying along the lines of,
Okay, so let's,
yeah.
can you hear me?
Yes, I can hear you now.
Okay, let's go to page 45 towards the top, where it talks about lending values, the second paragraph,
Uh-huh.
and the last sentence.
The bank usually bases its lending decision on the lower of the purchase price, in brackets cost, or the value of the subject property. So they'll always go for the lower price, whether it's the value, the appraised value, or the cost. Okay.
Okay, so the bank will lend based on the lower of either the purchase price, which is the cost, or the value of the property, the appraised value of the property. Okay, so that would be your answer. That is why you and that is why we use the 250,000, the sales price, as you indicated, of $250,000 as opposed to the property value of 260,000, right? And the bank will do this to ensure that the collateral risk is reasonable. Okay, so the bank always uses the low of the cost or value to determine the lending percentage. This ensures that the collateral risk is reasonable. If you haven't already, hold on, let me just checking something. Check something in your manual. Yes, okay. So in your manual, beginning on page 115, in your manual, beginning on page 115, you would have the answers to the review questions. Okay.
I didn't even know this manual had the answer.
Right.
I said I didn't even know the manual had the answers.
Yes, the manual has the answers. Okay, so yeah, okay. All right. Okay, so let's okay, so we've I just wanted to cover that question because I realized that I hadn't done that. You will not get a question like question number 7, okay? Because we haven't covered the be able to deal with that on Tuesday's class. So if I get my confirmation in time for Tuesday's class with regard to the new, the revised laws on VAT on real estate transactions, we'll go over that on Tuesday's class. Okay. If not, you won't have a question like question 7. Okay. So have everyone heard that?
Yes, sir.
Okay. All right. So let's get right into chapter 9. So, okay. So today's lesson, we're going to try to do both chapters 9 and 11. Chapter 9 covers documentation, compliance, monitoring and controlling, reviewing, and chapter 11 deals with when things go wrong, managing delinquency. Okay. So we're going to start on page 53. I just need to bring some things to your attention. Some amendments as we go along on page 53. They're more to the bottom. And then I think there will be 1 or 2 more amendments with regards to judgments. When we get to page 66. Okay. That is on chapter 11. Okay, so various documents used, they're not limited to these, but these are some of your primary documents used for lending. So you have your promissory note, your debenture, your legal mortgage, your chattel mortgage, a document, different banks call them different things. Some call them a pledge document, some call them a hypothecation, some say a lien. And one bank uses authority to hold bank balances for item number 5. And then there's, of course, the hypothecation of shares or assignment of shares. Okay. So we'll briefly go through them. A couple of them I have, because the documents are pretty short, I have gotten some examples off the internet of, so I'll be like the promissory note and one of the other ones, I think the number 5, or it might even be number 6. It might be number 6, I think. So number 1 and number 6, I've gotten off the internet. So we look at those. Then we look at document storage and management and control of them. Talk a little bit about the credit files and the security files. And then we'll be looking at some reports that we use to monitor and help us control what's happening with our loan accounts. So let's look at the first one of those is the promissory note. So it says here, this document is an unconditional promise in writing to pay on demand or at a definite time a sum of money. It is usually used when granting a personal loan, that is to say, purchase automobiles, furniture, education expenses, etc. Okay, so personal loans or consumer loans, you normally use a promissory note. Now there are some financial institutions that will say that even if you're giving a mortgage, they still want the customer to sign a promissory note. Okay, so the promissory note, as it says here in the opening, this is an unconditional promise in writing to pay. So it is your evidence of the customer's debt. Okay, in the olden days, back in my early days at Barclays Bank, we used to use regular checks. Okay, so we had like checks for the checking account, because a check is a promissory note. Okay, So a check is a form of promissory note. So the payee will be the customer's name, where it says pay to the order of on the check, pay to the order of Glen Nottage, the sum of, and then it's executed. Okay, by the customer, and of course the check will have the bank's emblem on it, have the date to the top. It'll have a number. It'll have a number, sequential number. So when you're referring to this particular loan, you said the loan has this check number, Nottage's promissory note. So if it's check number 127, on your collateral security document or register, it'll show promissory note number 127 for $5,000, dated such and such, Glen Nottage, right? And once the customer, we used to let them sign on the back of the check. Okay, very much like when you're cashing a check nowadays. The customer presents the check, it's made payable to them in their name. They want to cash the check. You have them endorse the check on the back in your presence as a teller, and that's evidence that they cashed the check, or they actioned the check, and that they received the money. So that was a simple way of doing promissory notes back in the day. Okay, on the screen you'll see two samples of promissory notes. The one to the top is not complete because a little bit below that, it'll have, like, for the signature, you'll have the terms, and then of course the person's signature, also signed off by the bank with the bank seal and whatever it is. So, but the first one is that blank to the top, that blank to the top left, you would normally put Nassau, Bahamas, right? Or if it's Abaco, Bahamas, or Freeport, Bahamas. And then of course, over on the other side, the date, you'll put the date. And the normal wording that you will find on promissory notes in the Bahamas is, for value received, and you'll say I or we the undersigned, and then you fill in the blank, located at such and such and such and such, hereby promises to pay the order of, to the order of, and then you put in the name of the lender, located at wherever they're located, the principal sum of, and whatever the dollar amount is, together with interest on the principal balance, and in accordance with the terms set forth below. And then the terms below will then outline what the terms are, how many, what the monthly payment is, and the actual interest rate, et cetera, et cetera. So you'll see that the bottom one actually includes that information. So it says promissory note, it puts the amount, the place, that is the country, city, well, we don't have states, but the country, island, the island and the country, the date will be included there, and says I, and whoever the person is, or we, if it's more than one, make commitment to pay so as XYZ company the sum of dollars. And normally the dollar amount is also put in words, okay, so that there is no there's no doubt as to the amount. So for all promissory notes, you'll find that it's in figures and words, very much like how you do it on a check. Okay, so here it is. It says repayment is to be made in the form of 200 equal payments at the interest rate of 7.2% of X amount of dollars payable on the 10th of each month, beginning such and such until total amount of debt is paid. And it says, in witness hereof, I set my hand on the seal this, whatever day of whatever month or whatever year, and I acknowledge receipt of a completed copy of this instrument. So the borrower will sign, and the printed name and address. They have their notary seal. So for some places in America, or I should say in America, they require a notary to seal it. Here in the Bahamas, we would use the bank's seal if it's not already attached to the document. Okay, so that's your promissory. That's your promissory note. Any questions on that before we move to the debenture?
No, sir. No, sir.
Alrighty. So debenture, it says this collateral can only be offered by incorporated companies or limited companies, which means individuals cannot offer a debenture because you have to be a legal company. Okay, so either an incorporated company or a limited company. And the debenture creates a charge over the fixed assets or the floating assets of a company, or even a charge over both the fixed and floating assets of a company. So I think we talked a little bit about what were fixed and what were floating assets in a previous class or classes. And I indicated at that time that fixed assets would be things like your buildings, any large equipment. So like a lot of the display, the large display refrigeration units in again the food stores and butcher shops and bakery shops, air conditioning units. So those will be fixed assets. Okay, the floating assets normally are your inventory. Okay, and that's because inventory changes from one day to the next. So as you get stuff in, by the end of the month, you may not even have any of that stock that you took in. So let's say a shoe store, you got in 200 pairs of shoes. You sold 150 pairs of them in 1 month. You only have 50 pairs left from that stock, but then you got in another 200 pairs of shoes. So the stock keeps fluctuating up and down, and moving in and moving out. So that is why inventory is referred to as floating assets. Okay, whereas fixed means that there's going to be hardly any change. So even, for example, if a refrigerator, even if like a display refrigerator goes bad and is replaced, the objective of the debenture is to still to capture that new piece of equipment. Okay, and this is one of the reasons for the annual review of business loans. So that when you go and you do a site visit as a lender to a commercial venture, and you see that, hey, this refrigeration unit looks different from the one that was there last year or several months ago, and then you check serial numbers, then you realize, okay, this is a new unit. So you'll have to make a notation to your file that the previous refrigeration unit was bad and is replaced by refrigeration, if it's Frigidaire or whatever it is, serial number such and such and such and such. Okay, so even though it may be replaced, it is still considered fixed in that, in the normal scope of things, it doesn't move like stock would move, okay, or inventory would move. So the debenture, it captures the assets of the company rather, now and in the future. It says whatsoever and whosoever, and that is some old English terminology. So, but it captures the assets in the company now and in the future, whatsoever, meaning whatever they are, whatever those assets are, whosoever is the owner at any point in time of the business. So if ownership changes or the leadership changes, the assets are still covered by the bank's debenture. Okay. And this document is prepared by lawyers. Okay. Some, well, I shouldn't say some, but I the set form of the debenture, and so sometimes it is completed by staff, and you need to be careful when you're completing some of these documents. So unless the staff member is a seasoned lender with experience in dealing with documentation, so they may be an experience with handling documentation. It's best to let the lawyers deal with it, particularly for some of the very large companies. So, you know, the Albinus Agency, your Kellys, John Bulls, some of those large companies, you would want the lawyers to complete those documents. Okay. Any question on that?
I'm good, sir.
Okay, so that's the promissory note and the debenture. Okay. The next one is the legal mortgage, or sometimes called the first demand legal mortgage. So this document charge over specific real estate. Okay, so some mortgages serve as all monies or continuing collateral, which by nature allows the borrower to reborrow against the same collateral security document. So let's unravel this piece by piece. Okay, so this document creates a charge over specific real estate. So the legal mortgage, as with most, if not all, documents that have to be stamped and recorded, will have what they call a title page or a cover page or a front page. And what is kind of almost like a contradiction of terms, that page is normally affixed toward the back of the document. Okay. But it outlines, it tells you what the document is, who the parties are. So it'll say, you know, mortgage agreement between, you know, Biff's Bank and Glenn Nortage. They'll say, and then it'll say consideration amount, which means whatever the mortgage amount is. So if Glenn Nortage is borrowing $200,000 from Biff's Bank, it'll be the consideration amount would be $200,000 on the front of that. And then it'll have a brief description of the property being held. So if we're using the description of the Rolls property in Eastwood, so it'll be Lot 34, Block 5, Eastwood Estates, Nassau, Bahamas. Okay, and then of course it'll have some other notations on that cover page. But the page will be able to tell you what the document is, whether it's a first legal mortgage or second legal mortgage or further charge, who the parties are, the amount being considered, and where the property is located. It's a short, brief description of the property, no real details. Okay. So the next sentence, some mortgages serve as all monies, or as continuing collateral, which by nature allows the borrower to reborrow against the same security document. So what that means is that it is like a revolving mortgage document, as opposed to documents that have, there may be some mortgages that say it'll state not just a fixed amount, but it'll state, you know, payments at such and such and such, and it may even state an expiry date. Okay, so once you see it has either the number of payments or states an expiry date, it is not an all monies or continuing collateral. I'm trying to, let's see, Finco and Fidelity, I believe. Finco and Fidelity had something which they call a banking facilities mortgage. So it would state who the parties are, it would state the consideration amount, and it would state the property being covered. But it would not state any length of time, like any number of payments. It will not say 300 payments or whatever it is. So if that document, that particular mortgage document, which I think they call the banking facilities mortgage, if that document was stamped and recorded for $200,000, and I had borrowed and I had taken my balance down to $50,000, if I had taken my balance down to $50,000, I can go back to them and borrow up to 100, or another 150,000 to take it up to $200,000 without having to go through the process of getting a new mortgage document drawn up through the lawyers. So the process, the purpose of that is to avoid the to avoid the customer from having to go back to the lawyers and incurring additional legal fees. Hold on a moment for me, please. Okay, sorry about that. Someone was operating a machine outside my window. So I had to deal with that. Okay. So did you hear me clearly about the continuing collateral or all monies mortgage document and banking facilities mortgage?
Yes, sir.
Okay, all righty. Yeah, like I said, at the time I was competing with some machinery outside. Okay, so that's a legal mortgage or first demand legal mortgage. And again, like I indicated earlier, a second mortgage or a further charge would be similar. Okay, so you have a first legal mortgage, and then sometimes the bank will take a further charge or second mortgage, or even another financial institution may take a second mortgage over a property, and the document is pretty much laid out in the same manner as the first demand legal mortgage. However, further charge or a second mortgage
Cut out, Mr. Nordich. Anybody else there, Mr. Nordich?
No, I can't hear him.
Oh, man. Hello, I think we're back now. Can you
Yes,
hear me?
sir. Goodbye.
Okay. All right, I heard someone talking and then it was fading in and out. Could you repeat what you were saying or asking?
No, I was asking the question if anybody else could hear you because I could see your box light up, but we wasn't hearing anything.
Okay, so what was the last thing you heard me talking about?
Where you were talking about the continuing collateral, whereby a person could take out a second mortgage and so forth, another institution could take that up and so forth.
Okay, all right. Yes, so I was saying with the first legal demand mortgage, a second mortgage or a further charge, the mortgage document would be pretty much set up the same way as the first legal mortgage or first demand legal mortgage, right? But both the further charge and the second mortgage must refer to the first mortgage, okay? So it must acknowledge that there is a mortgage outstanding, a first mortgage outstanding, whether you use a further charge document or use a second mortgage document. Is that clear?
So if let's say for instance, I took out a mortgage and I go back to see if I can get some additional funds, they would call that the second demand mortgage or reference the first demand mortgage.
Well, what they will well, if it's at the same financial institution, normally they would do it by further charge over the same property, and that further charge would reference the first mortgage. So in some of the wording at the beginning of that document, you'll make reference to the fact that the client borrowed XYZ amount of money on by virtue of this document dated, and so it'll actually refer to that particular document.
Noted, sir.
Okay, and similarly, if for whatever reason the person goes to another bank and gives them that mortgage, that same property to hold, that bank will take a second mortgage. Normally they'll say a second mortgage over the property. And again, it has to refer to the first mortgage. And that is all captured by the attorneys doing the documents, because they do the title search and all that sort of stuff. And in doing the title search, they'll come across where there is a first mortgage on that property at another bank. Okay.
Yes, sir.
Okay. So let's look at chattel mortgages. Okay. So chattel mortgage is, by virtue of its name, it's a mortgage over chattel. Okay. And what are chattels? Well, let's look at what this definition is saying to us. The chattel mortgage creates a charge over non-fixed assets that are easily identifiable and could be used to capture vehicles, equipment, furniture, livestock. That should be livestock in your books, not livestock. Okay, so L-I-V-E, livestock, etc. Okay, so if you were in the farming business and your bank was lending to farmers, you could take a chattel mortgage over livestock. Okay. Well, the most common that is used in the Bahamas is to take a charge over vehicles and furniture. And one of the more common, or I should say, what one of the more most known banks for doing that, particularly going way back, was Commonwealth Bank. And that's for the time, and they were called Commonwealth Industrial Bank. So that's going way back. So they would take a chattel mortgage over vehicles and furniture. And interestingly, their chattel mortgage gave them the right to break into your house and into your garage to recover their vehicles or the furniture. So when the customers signed, the customers gave them a right. So when the bank came to repossess their vehicles or furniture, you did not have a leg to stand on if you had signed one of those chattel mortgages. Okay. But things are so dangerous nowadays.
Yeah, I was going to say that, Mr. Nordich. In collections, I remember one time a fellow was sharing, a fellow collector at another institution, and he was saying that they went to get this car. And what the fella said, the fella come at the house and tell him he heavy. And you know the man ain't talking about him being fat. So he just eats up out the yard, said, you gotta send the police back to get the car. Boy, gang, what? No. It's dangerous to be a collection officer like that now.
Yeah. It was dangerous then, but it's even more dangerous now.
What?
And so that is why you'll find banks may probably use collection agencies who probably have drones. And so if they know where the people live, they'll just fly the drone over there. Wait until the people pull out the driveway, follow them to wherever they're going. And when you go into the food store or church, when you finish the church service, you come out saying hallelujah and whatever it is. You can't go on,
Somebody thief my car.
So the wrecker will be there and take the car away. So, or even if they have the chattel mortgage over your furniture, they'll still try to get it. The bank will still get a court order to enforce the collection of the furniture or your equipment in the store. Okay. And again, even with the court order, like you indicated, you have a police officer, uniformed police officer, or officers go with you. Because nowadays, a lot of people don't even respect people in uniform. So it's sad that we are evolving, but that is also the way the world is evolving. Okay, so that's promissory note, debenture, legal mortgage, chattel mortgage. So let's look at the pledge. Okay. The pledge or hypothecation or lien authority to hold. Okay. Again, let's look. There's some corrections that need or amendments that need to be made in your book. This is typically used for liquid assets. In your book, it has fixed. That should be used for liquid assets taken as collateral. Put a full stop there, and then a new sentence. Take out the word but, or put a line through the word but, and primarily should be given a capital P. So you have two different distinct sentences. So the pledge or hypothecation or lien or authority to hold is typically used for liquid assets taken as collateral and is primarily used to capture credit balances on any bank account at the bank, at that particular bank. It doesn't capture any balances at bank accounts at other financial institutions, only the institution where the loan is. The authority is only extends only to the particular bank. Okay. So if you have, if Glenn Knowledge borrows in his single name but he also has an account there with one of his parents or his wife or his children, or he has a fixed deposit, or a business account that he's the proprietor of. The bank can go into those accounts and take the money if they need to make a payment or settle an outstanding debt if it needs to be settled in totality. Okay, so again, some banks call them different names: pledge, hypothecation, lien, or authority to hold. Okay. Then you have another type of hypothecation for hypothecation of shares, right? Or assignment of shares. Okay. So this differs slightly. Well, it differs from the hypothecation above. The hypothecation above was for liquid assets, such as cash. This one is specifically for shares or share certificates, ownership in publicly traded publicly traded stocks. Okay, so the lender could choose to accept shares, preferably on publicly traded stocks, but in special cases, accept shares on privately held companies. Very rarely do we take that risk here in the Bahamas on privately held companies. Most of them are on publicly traded stocks or businesses. Okay. In the past, the lender would obtain, that is in the Bahamas, in the past, the lender would obtain the borrower's signature in blank at the back of the share certificate and in blank on a power of attorney form. So on the back of a share certificate, because like I said, in America and probably some other jurisdictions, they still issue share certificates. Okay. And that's kind of like what a share certificate would look like. Okay, so there's a share certificate. This is certified that this person is a registered holder of 1,000 shares, fully paid up in XYZ company, subject to the memorandums and articles of association and to the terms, conditions endorsed thereon. And so it'll be signed by normally two persons, have the company seal, and you see to the top, Inc. number 001. So the certificates would have serial numbers. Okay. Now on the back of that share certificate is on the back of that share certificate is a blank transfer. A blank transfer. I guess there's some wording on the back of it. So if I wanted to transfer those shares to someone else, there's a transfer form on the back. Like our old, the registration, the car registration forms, the old ones that we used to have before these new ones. On the back, if you was for selling your car, there's a section on the back, there's a fold over, and then you would sign it out, as the owner to whoever you're selling it to.
License disc, right?
Sorry?
Used to be on the license disc as well, right?
The license disc, yes. The previous license disc. Nowadays we have a owner's certificate that you'll sign off on. So it's very much like that. So so on the back of this is this transfer, the wording for transfer, but and you'd have them sign it in blank and undated. So it will not be dated, and it won't name who the person is who's receiving it, because it's only signed in blank by the owner of the certificate. In the likely event that they default, then the bank will fill in the date and who they sold those shares to. Okay, so that's in the past, but it's also still being done in other jurisdictions, because in the Bahamas we pretty much did away with share certificates, And so the administration of shares in the Bahamas is through the BCSD, the Bahamas Central Securities Depository. So they'll have a register of all the publicly traded stocks, who the owners of those stocks are, and whether or not there are any of them are assigned to any financial institution or anyone else for that matter. Okay. One of the downfalls with the actual certificate is that a lot of people, what they did was in the past, they went and they reported to the company. So, for example, back in the day, Bahamas supermarkets were city market, right? So people had shareholdings in Bahamas supermarkets, which was city market, like I said. And so a lot of them would assign their Bahamas supermarket shares as security for loan. But what they do is they go to Bahamas supermarket's head office and they'll say, I lost my shares certificate. Okay, knowing fully well that they pledged it to, say, Royal Bank. Okay, so Bahamas supermarkets would then make a note that share certificate number such and such was lost, and they've issued a replacement. Okay, and so then the person now has a new certificate for their shares, and they'll go and they'll either sell those or they'll use it and pledge it to another bank for a loan. Okay, so with the Bahamas Central Securities Depository now, they register all the shares. So any movement in the shares, there's no likelihood of that happening where people are saying, well, I lost my share certificate, I need a replacement. Okay, so that was one of the reasons for doing away with using share certificates. The other was that there was also pressure brought to bear on the Bahamas for using bearer shares and bearer bonds, okay, because of money laundering and drug trafficking and whatnot. There is, I think, Delaware in America may be one of the few in the world where they still use bearer shares. And it's interesting because America was one of the G7 countries that were telling the rest of the world they need to do away with bearer shares, okay? Because they needed to trace the ownership. So bearer shares, it just says the bearer of the certificate is entitled to say 100,000 shares. So whoever the bearer was, they owned 100,000 shares, okay? Because there was no name. It didn't say Glenn Nottage owned this or XYZ company owned these shares and this other company. And so the whole thing of looking at share certificates initiated with bearer shares. And so in the Bahamas, we made the decision to have our companies, even though they may issue a confirmation to a customer that you have XY shares in a company, that is not a negotiable instrument. It's just simply a notification that you have ownership in a particular company of XYZ shares. But the registration of that and the sale back and forth of that those shares are through the BCSD. Okay. So again, that's the share certificate. Here's a sample assignment of shares form may look like. Okay, so between this company and the person who's assigning them, the terms, one for value received, and then it says the assigner warrants the assigning that the shares are fully paid up, and the assigner owns the shares free and clear of all encumbrances. Okay, so if you have those, if there's an encumbrance by another bank, and the bank that's giving you the loan, who's taking the assignment of these shares, finds out, that can be cause to call in the loan. Okay, the loan doesn't have to be in default, because all loans are payable on demand. That means if I need my money now, whether you current or not, I can demand you make a payment in part or full now. So that's what demand loans are about. Okay, so when you say on demand, that is exactly what it means. You pay on demand. Okay. So any questions on those few documents that we looked at? Like I said, those are not exhaustive, but those are some of the main ones that are used in lending. So any questions?
No, sir, no questions from me.
Okay.
That's for me, sir.
Okay, so let's look at documentation, storage, management, and control. Okay. Let's make sure there are no more changes that need to be made. Okay. Okay, so documentation. Okay. So it says here the credit file. Well, let's read the first paragraph on top of page 54 first. Okay. During the loan approval, the manager or credit officer would list in detail all security items that will be taken to support the transaction. Most banks would require a separate security schedule to be prepared along with the loan application form. The loan application form, invoices, financial statements, business plan, and other supporting documentation will be placed in a credit file along with a copy of the security schedule. The original security schedule, along with all original security documents, will be placed in a separate security file. Okay, so here we are introduced to the credit file, and secondly, to the collateral security file. Okay, so the credit file and the collateral security file or security file. Okay, the credit file is typically stored in locked cabinets within the credit department, and in some cases in a book vault. Banks make it a mandatory requirement to store security files either in the main cash vault or a separate proper vault. And when I say proper vault, this is one that has some sort of fire resistance to it and is under dual control. This is because security files and the documents therein represents the bank's possible claim against its customer or customer's assets. And at the very minimum, the bank's safekeeping of those assets. Okay, so that is the items like we talked about: the promissory note, the debenture, the legal mortgage, the chattel mortgage, assignments. If there's a guarantor, we have their guarantees. So any legal documentation, conveyances that show a root of title or how the title is passed down from one person to your client. All those documentation are held in security files and are locked, usually under dual control, in a secure and usually fireproof vault. Okay, or if not, the filing cabinets in which they are kept in those vaults have a fire rating, and each bank has their own fire rating. So it could be a 2-hour fire rating, a 3-hour fire rating, a 5-hour fire rating. And by that I mean a fire could be raging around it for about 2 hours, 3 hours, 4 hours, 5 hours before the integrity of that filing cabinet is affected. Of course, the higher the rating of the of the filing of the fireproof cabinet, the more expensive they are. So a 5R rated filing cabinet, fireproof cabinet would be much more expensive than a 2R fire rated filing cabinet. Okay. What else I want to say about that? Yeah, I think that pretty much covers the credit files and the security files. Any questions on that?
I'm good, sir.
Okay. There's a section now that says discuss the role of the facility letter, the customer's acknowledgement of credit terms, margins, and covenants, including required collateral security. So I'm just going to just say briefly about the facility letter. The facility letter, once a loan is approved, once a letter is approved, the customer is advised that the loan is approved. The bank issues what they call a facility letter or a commitment letter, or an offer letter, I should say. And in it, it outlines, it'll be addressed to them and say what the amount is of the borrowing, the purpose of the borrowing, the interest rate, the term, and then a list of conditions. So whatever collateral security is being held, if we need the whole life insurance coverage or building insurance coverage, or if it's going to be a construction loan, contractors all risk, and whatever else is required. So it'll list those items, and then it'll be signed off by an authorized person in the bank, and then to the bottom will be an acceptance section where the customer, if it's an individual, he or she will acknowledge it. If it's more than two people, they will acknowledge with their names separate. So if it's like in the case of Martin and Sherry Roll, Martin and Sherry Roll will sign singly. At the bottom, if it's XYZ company borrowing, will be addressed to XYZ company, and then you'll have whoever is authorized to sign on behalf of the company for this particular loan. Those will be the people who would sign the commitment letter. Okay, so going back to our earlier chapters when we were talking about the board issuing a document authorizing stating who can sell, who can borrow, how you can borrow, et cetera, et cetera. Okay, so so those persons who are authorized, they would be the people who sign on behalf of a company. Okay, so that's pretty much the facility letter. Some banks call it the offer letter. Some banks call it a commitment letter. Okay, and also there's a fee. There's normally what they call a commitment fee or facility fee that is required upon acceptance, and that could range anywhere from 1% to more than 1%. 2%, 2.5%, 3%, whatever the case may be. Depends on the financial institution and depends on what type of facility it is. Okay. All right. Okay, so let's move to monitoring and controlling. Okay. Okay, so in order to effectively monitor and control accounts, bankers must review various reports. So you have daily access reports, you have periodic arrears reports, margin reports, and we're going to talk a little bit about each of those in a bit. Okay. Okay. So in addition to reviewing daily excess reports, periodic arrears reports, and margin reports, you must examine frequent encroachments or temporary increases to credit facilities. So what does that mean? Frequent encroachments or temporary increases. So for example, if you're looking at an overdraft report, whether or not the person is going over the limit, the overdraft limit, or if they don't have a limit, they're going overdrawn, and are you approving those, right? Or if they have an overdraft limit and they come to you and they say, listen, you know, my limit is $1,000, but I need it increased to $1,500 just for 2 weeks, right? So you want to look at these temporary increases to credit facilities, okay? You must conduct testing of your covenants, okay? And we're going to look at that in a bit. That has to do with reviews of reviewing the files and reviewing your collateral security, etc. They must also conduct a comparison of actual, and this is for business accounts, conduct a comparison of actual to projected financials. So when a company comes to the bank to borrow, they will show for the last 3 or so years, they'll have financials for the last 3 or so years, and then they'll do projections for the next 3 to 5 years. Okay, so once they've gotten the loan, you want to see, okay, so you got this loan in 2021, in 2020, you got this loan in 2020, the end of 2020, 2021 has passed. We had your projections for 2021 when you came to the loan in 2020. Okay, so we want now to see how you actually performed against with your projections that you said that you're going to make. So are they on target? Are they ahead of target? Or are they below the target? So for example, if you indicated that in 2021, you're going to have $50,000 in sales, but instead you only had 40,000 in sales, actually in 2021, then as a loan officer, you need to look at them and say, okay, why didn't you meet the 50,000 that you targeted? Okay, there's a shortfall of 10,000 here. And so there could be some reasons for that. Okay, and one, given where we're just coming out of COVID, it could be, we only just came out of being released, toward the end of 2021. So we weren't anticipating, from 2020, still being in lockdowns or partial lockdowns, et cetera, et cetera. Or it might be a management problem, or it might be an accounting deficiency. So whatever it is, you would need to discuss it with the borrower, the owner of the business, to find out what happened, and if necessary, it may require them adjusting their projections if they foresee in the future that the economy is not going to pick up to the level that they anticipated anytime soon. Okay, so you may ask them to adjust the projected financials to correspond. But again, that's kind of complicated, and so even persons who are experienced lenders, unless they are experienced in lending to businesses and doing financial analysis, they won't be involved in this type of thing. So the person must have experience, not just be an experienced lender, but they must have experience in dealing with business loans. Okay, so normally you won't have a novice managing an account. They may be assigned to work with someone who is a seasoned lender in commercial lending. Okay. So just because the person has been in banking 20 years doesn't mean that they may have, or in lending 20 years, doesn't mean that they may have done commercial lending. Or if they've been in mortgage lending for 20 years, they may not understand consumer lending. And so they have to be trained. Okay. It's pretty much like let's say for the police, for example. Okay. Sometimes, I used to wonder, initially, there was an accident and you see a patrol car pass and you say, well, traffic backing up and whatever because of this accident. Why don't they stop? Because they're not trained. They may be forensic police. Okay, they're not traffic police. So while they may be a sergeant or an inspector, traffic is not their area. Excuse me. Traffic is not their area of expertise, right? So they have to leave that to the traffic experts, vice versa. There's a murder scene. You're not going to have a traffic cop going to investigate a murder scene, okay? So you want your detectives who are trained to deal with murder scenes and those types of crimes, dealing with those, okay? So any questions?
I'm good, sir.
Okay, so bankers has also carried out periodic site visits and spot check inventory. Again, this is for business loans, business lending. And also take notice of the passage of any new legislation affecting the industry, any new entrants in the industry. So will any new legislation affecting the banking industry or the industry in which they're financing, new entrants into the industry in which they're financing, or increased marketing strategies from competition, the client's competition, or any negative client publicity that may affect their client or the industry in which their client is in. Okay, so it's quite it's not as superficial as people may think. The astute lender will try to keep on top of what is happening. So, for example, we said that there's been some changes to the VAT Act as it relates to real estate sales, right? So that is being unraveled and being watched. And if it hasn't already been, if it hasn't already trickled down from executive management from each lending institution, how it's going to be processed, it probably will be done within the next few days or weeks. Okay, so again, new legislation could affect the financial institutions industry or the financial sector, as well as it could affect the industry of the customer who is borrowing. Okay, or both. Okay. So reasons for monitoring and controlling. Okay, so the first one, the ongoing monitoring and controlling of accounts helps to identify, to prevent, and to minimize potential risk and losses that might occur due to a material adverse change in the affairs of the borrower. The effective monitoring and controlling of accounts also serve to improve the quality of the loan portfolio, that is the asset quality, and provide training to lenders wherever necessary. Thirdly, the monitoring of accounts, for example, covenants report and annual credit reviews, also helps to identify whether companies are performing financially well, and where applicable, identify additional sales potential for the bank. Okay, so when it says, and where applicable, identify additional sales potential to the bank, we do a lot of cross-selling. So So if we're in mortgages, we still probably have to sell some deposit accounts or credit cards, or whatever it is, and vice versa. With credit cards, we have to sell some mortgages, consumer loans, etc. So you're looking for opportunities. So you can see in the business, for example, if the person is having increased credit card sales, and your bank has, some of those machines, the handheld machines that are wireless, you may want to introduce them to those. Okay, so you're looking for areas where you can make, where the bank can make more money off the customer. Okay. So let's begin looking at some of these reports. Okay, so the first one is that we talked about was the daily excess report or exception reports. We have frequent encroachments or temporary increases. You also want to look at suspense account reports. For example, your adjustment suspense. And so our suspense accounts, those are, you don't want those to be overdrawn. You want to balance those on a daily basis. You have stipulations as to how long an item should remain in a suspense account. Okay. Again, going back to exception reports, you have like for example, overdraft, either where there are limits, where the customer has an overdraft facility, or where there's no overdraft facility, but the customer has gone overdrawn. So you want to monitor those. Also in the exception reports would be things like anything else that may be out of the ordinary. Okay, I was about to talk about interest rates, because those are exception reports, but that's the next one that we're going to actually look at when we look at the margins report. Okay, so you're looking at your margins report or interest rate reports. Because you want to look at those, because when a loan is booked, the next day you want to make sure that the correct interest rate has been charged on that particular facility. Okay, and so some of the red flags would be, for example, if we know consumer loans attract interest rates in the area of say 14 to 16%, but then we see a 12% interest rate on a particular loan, we should look at that to see, why is that interest rate at 12%? Was that an error, or was there a reason for it? And we'll probably find out that because the customer, maybe they pledged a fixed deposit. It wasn't 100% secured by cash, but they secured it by some cash. And so we said, okay, since we're holding some cash, instead of charging you 14%, we'll charge you 12%. Okay. Or if it was a 16% interest rate, and depending on if it was more substantial sum of money, so that is why we charge them 12 as opposed to 16%. Okay. But the margins report should alert you to whether or not the interest rate is correct. So similarly, if you see a mortgage loan with a 16% interest rate, hey, none of our mortgage loans are 16%. Okay, so what went wrong, right? So the margins report is a very important report as well. Then, of course, this is where it comes to delinquency, delinquency control, which is the next chapter we'll be looking at. We may get to that tonight, chapter 11, but your periodic arrears report. So it'll show your accounts that are delinquent, and then those that are non-performing. So your delinquent accounts will be any account that is from 1 day to 89 days. Okay, so delinquency, well, actually, you can say all accounts from 1 day and over are delinquent, okay? But to try but banks really do, and we say our delinquency to differentiate between the non-performing loans, we will say delinquency is anywhere from 1 to 89 days. Once it goes 90 days, it becomes non-performing. And so we'll have two sets of reports, delinquency reports and the non-performing reports. And then the delinquency report itself, it has anywhere from 1 to 30 days, and 31 to 60 days, and then 61 to 89 days. Okay, and then as I said, anything 90 days and over is non-performing. Okay, that's where it's they've missed 4 payments. Okay. Then you have your collateral security compliance or monitoring reports. Okay, this is where you check on your covenants, your collateral security, any items that might be out of order. So if you have, let's start with the mortgage document. Do we have the stamped and recorded mortgage document? Okay, we don't have the stamped and recorded mortgage document. Do we at least have the receipt from the registry say that it was lodged for recording? Yes, we have that. If not, then you need to go back to your attorney and say, hey, we don't have the registry receipt. Please at least send the registry receipt, evidencing that this mortgage document or this chattel mortgage, if you are recording a chattel mortgage, has been recorded or sent for recording at the registry of records. Okay, similar for like insurances, whether it's building insurances or life insurances. This report will normally tell you that in the next month or 2 months or 3 months, this building insurance will be expiring or this life insurance will be expiring. So it'll give you notice in time for you to contact the client or whoever's charged with dealing with that to say, this is about to expire, so follow up on this. Or if it was allowed to expire, it would show that the homeowner's insurance expired or the building insurance expired. This is particularly important on insurances, building insurances, when you are approaching the hurricane season. Okay, so in the hurricane season, which starts in June and ends in November, you want to make sure that there are no expired building insurances. Okay, because if a hurricane starts to travel, once it gets, I think it gets to warning, a watch or warning, and you find the insurance is expired, the insurance company will not renew that certificate until after the hurricane or the storm passes by. So it is important to stay on top of that particular that particular report, your expired insurances. Okay. So continuing, so monitoring and reporting compliance or non-compliance. This has to do with your credit risk rating reports for your client's accounts, including both deposit and credit accounts, politically exposed persons as PEPs, etc. Right, or watch list accounts. So anything related to compliance or non-compliance. So you want to look at your risk rating. So normally those clients that have a higher risk rating, you want to look at those first to make sure that they are compliant, that you have all that is necessary for them. You have the building insurances, the life insurances, assignments of those life insurances, the collateral, the recorded documents, or at least the register receipt. You have the annual business license if it's a company, et cetera, et cetera. Okay, so so the compliance and non-compliance reports are essential. And then, of course, I alluded to this annual credit review report. So this is separate from just checking in the compliance or non-compliance, the risk rating reports. this is actually now going into the account and doing a full review of the account. So you're looking at, if it's a business account, you're looking at their financials. Have you received the financials for the current year? If not, you have to follow up for those financials, or have the account officer follow up for those financials. And the accounts that are subject to annual reviews, overdrafts, all commercial loans, and politically exposed persons, whether those politically exposed persons are current or not, whether they are overdrafts or not. If they're consumer loans, if they're just regular checking accounts or savings accounts, you have to do an annual credit review or annual review of your PEPs. Okay, your politically exposed persons. Then, of course, not all banks have this, but some banks will have it. What they call portfolio size stratification report, where it lists the accounts by balance or exposure size. Okay, so normally you have your you will have here are my my individuals who are borrowing, and so so I have from the highest balance to the lowest. Here are my commercial loans. I have from the highest balance to the lowest. Here are my overdrafts from the highest to the lowest. Again, individuals and commercial overdrafts. So it's a portfolio size stratification report. You want to see what risks your bank, your financial institution is exposed to by size. Okay, because if there's some troubling signs, you would want to start with your larger accounts, deal with them first, because they have the greatest potential of affecting your or impacting your delinquency ratios. Okay, so the larger the loan balance, the more impact it's going to have on your delinquency ratio of your portfolio. So again, you want to be aware of any early warning signals. Again, these will come from your some of the reports that we looked at earlier in the previous slide, your daily access reports, your periodic repairs report, arrears reports, etc. Okay, and then you want to manage your arrears reports, and this is when you actually get into doing your calls. Okay, any system generated past due notices, formal letters, demand letters, any collection activity, any repossession or foreclosure activities. Again, with respect to delinquency, non-performing, problem, and watch list accounts. Okay, and watch list accounts again would also include PEPs, politically exposed persons, because from time to time, those persons do go into arrears themselves, politically exposed persons. Okay. So any questions on that?
It's a lot to take in, but I'll get it.
Yeah, I mean, like I said, if you have any questions, questions about it, jot them down. We'll tackle them on Tuesday. Go through it. Anything you didn't understand or didn't remember, even if it was, that's what I'm here for, to make sure you understand whatever's being taught, particularly this section, monitoring and controlling, because this is very a very essential part. Monitoring and controlling is very essential. And when we did that spreadsheet, when we talked about monitoring and controlling, we saw that every one of those 4 areas, whether it's administration, whether it's the adjudication persons, whether it's the administration, or whether it's loan servicing, any of those 4 pillars have some measure of monitoring and controlling that they have to do of the various accounts, particularly lending accounts or loan facilities, right? So it is very important. In fact, in my risk management course, I actually, in that and mastering mortgages, I introduced something that I call RAD, being RAD, R-A-D, which is the short for being radical. Bankers need to be radical, okay? And by that, I mean, the R means that as a banker, you must be a person who likes to read, who has a propensity to read, because there's a lot of stuff to read, your manuals, the loan applications, the stuff that are coming in with the loan applications, business plans, financial statements. Okay, so there's a lot of reading that's required. Also, reading to keep up to date on what is happening in the industry. So reading your periodicals. And for those who, don't like to read too much, well, watch the news, particularly the business news. That's what's happening in the business community in the Bahamas, as well as internationally what is happening, particularly in America and around the world. Okay, because as the saying or the cliche goes, if America sneezes, the Bahamas catches a cold. Okay, so if you see something happening in America and like now they're going through a recession and they're denying it, hey, they're talking about high gas prices. We have high gas prices ourselves. Okay, so we are very close to America, and also even though Europe may be thousands of miles away, what happens over there can affect us as well. So even in the Middle East. So if the Middle East countries say they're not going to provide America with additional oil, or the West with additional oil, then gas prices will go up. So what is happening in the Middle East, what is happening in Europe, will impact us sooner or later. So that's where the R comes in, reading, which also means, like I said, being aware of what's happening globally by listening to business news or reading the business section of our local newspapers. Okay. The A is attention to detail. You must be a person who pays attention to detail when you're dealing with lending. Okay. So that's the A. And then the D in RAD is document and document. Okay, it's two D's spelled the same way. Document, which means you got to be a person who likes to document stuff, write things down. And also you must be concerned with the documents that are being used. So your collateral security documents, and that they are properly secured. They are properly secured, that you actually have them, that they're properly prepared. Okay, so that's where you get your RAD from. Okay, so that's not a requirement for this course, but I'm just throwing that in there to show the importance of reading or being aware of what's happening in the industry locally and abroad, paying attention to detail. That's attention to detail. That's A and RAD. And D, document whatever you have to do. Keep track of if it's something that has to go into customer's account, the customer's credit file or whatever it is, or taking some notes for during your interview with the customer. And then of course the document, meaning collateral security documents and or secondary documents like assignments, salary deductions that have been acknowledged, etc., and recorded legal documents. Okay, so that's RAD. Read, attention to detail, and document. All right, so that covers this chapter. Okay. So we looked at promissory note, the debenture, the legal mortgage, the chattel mortgage, the pledge or authority to hold bank balances, the hypothecation of shares or assignment of shares. And then we looked at document storage, management and control, monitoring and controlling, relative to our credit files and our security files. Okay. So, any questions before I move on?
I'm good, sir.
Okay, so let's go to chapter 11. Chapter 11. And again, before we go to chapter 11, just let me make a note about doing the review questions. Now that you're aware that the answers are in the back of the book, try to attempt the questions first without looking at the answers in the back of the book. Okay, so all right, so yeah, okay, so there's 7 questions there for chapter 9. Okay, so let's move to chapter 11. When things go wrong, managing delinquency. When things go wrong, managing delinquency. Okay. So in here we have says at the top of our page 65, review the causes and warning signs associated with typical bad and doubtful debts. Examine the identification and treatment of them on the bank's books, in internal and external watch list reports, doubtful and non-performing reports, write-off register, etc., and how to manage accounts towards recovering debt. Okay, so the first thing we want to do is when there is an account goes delinquent, one of the first things you want to do is you want to determine whether the problem is internal, an administrative malfunction, or whether it is external. It is due to the customer not paying or something going wrong in the economy, or some, what do you call it? Act of God. I don't like using the word act of God, so I use the word nature. Okay, that's hurricanes, floodings, that kind of thing. Okay, or wildfires, which are prevalent in California. So again, we need to determine if it's internal or external. If it is internal, you need to resolve it quickly, because, for example, if the customer gets a payment, the customer has a payment that came in, but it didn't go through the account, and maybe sitting on one of your suspense accounts because for some reason something may have maybe a digit was missing for some reason or whatnot. Quickly check to see if it's on some suspense account, and if it is, try to transfer it to the customer's account quickly. Okay, so if it's an internal, resolve quickly, or it could be that the money is there on the customer's account, but for some reason the standing order, the automatic transfer, stopped working for some reason. So you need to check that and probably some other customers' accounts to see if other customers may have also been affected. Okay, if it's external, you need to determine whether the problem is short-term or long-term. Okay, that is whether it's a temporary situation or whether it's a permanent situation. All right, so it could be that your customer, is has a, it's just a short-term thing. Maybe they are between jobs, but they have another job lined up, or they've been laid off and they don't have another job in sight. Or it could be that the customer is hospitalized and now paralyzed and won't get back to work, or the customer died either through sickness or accident. Okay, so you want to make, again, whether or not it's internal or external. If internal, resolve quickly. If it's external, then you want to dig down and determine whether or not it's short term or long term. So what we're going to look at is the chart here. Okay, and we're not going to go through these individually for the sake of time, and go through them one by one, like I may have done for some of the other in the past. I'll just show the completed chart. Okay, so so some of the causes of delinquency are poor loan interview, which is an internal problem, and this mistake was made at the beginning. Okay, the second one was inappropriate financing tranches, or inappropriate, or you gave them the wrong credit facility. That's what this means. That's an internal problem, and that was at the beginning. Improper loan structuring. The loan wasn't structured properly, so that's an internal problem that was made at the beginning of the loan. Improper or faulty loan support. That's an internal problem at the beginning. Disbursement problems, again, that's internal at the beginning. If the customer is facing competition, that's an external problem and happened after the loan is made. Adverse changes in the economic situation, local and global, that's external after the loan is made. Adverse other external developments, local, regional, global, again, that's external after the loan is made. Changes in management, again, that's external. This is with regard to a business where they may have changed management, a business loan. That's after the loan was made. 10 is changes in employment, that is unemployment, underemployment, reduced work week, reduced income, existing or new job, pay structure change from base salary to commission or gratuity, or the person is now self-employed. Okay, that's an external issue that was made, that happened after the loan was made. And we can go down each one of those. I'm not going to do it here tonight, but you will certainly have this to look at. You won't be quizzed on this because this is not in your book. But just so you can appreciate when we talk about internal problem or external problem, and how to where it occurred and where the mistake was made. Okay.
Mr. Nottage, it seems as though I'm missing this chapter 11 and even chapter 12 in my book. Because
chapter 11 and 12.
Yeah, because it jumps from page 59 and goes straight to page 70, like mid 70s, I think. Let me see if I can find the exact page. Yeah, the review questions for chapter 12.
So, okay, let me just make a note of that. So that's Danielle.
Yes.
And you say you're missing pages what?
It goes from, it stops to 59 and then it jumps to 74.
Okay, so you need pages 60 to 73.
Yes, sir.
Okay, all right. Now, and anyone else are missing any pages? Okay. What I would suggest you do is after this class, everyone go through your book to see if you're missing any pages. Let me know as soon as possible, and I'll have them sent to you. Okay. So tonight, Daniel, I'm gonna send to you when I send the homework. I'm gonna send to you separately pages 60 to 73. Okay.
Okay, thank you so much. Appreciate
Okay.
it.
No problem. All right. So again, we talked about going back, determine whether the problem is short-term or long-term, temporary or permanent. Okay, so so piggybacking off that temporary or permanent, let's go to the cannot pay customer. Okay, so this is where we get into the psychology, basically, the mindset of individuals. So here's a person who is willing to pay, but for some reason, either there's a temporary situation or a permanent situation that he, she, or they cannot pay. Okay, so what we are saying here is there are two forks in this road. So if it is temporary, explore any workout solutions. Okay, so we'll talk about that in a little bit, right? So as to what are those workout solutions that we can probably deal with the client. So if it's temporary, explore any workout solutions. If it's permanent, and this person was a good customer, but they're now experiencing some hard times, try to consider some ways to ease the burden on them. Okay, so the bank during COVID, the central bank asked financial institutions to find ways to make it easy for customers to take the burden off customers, and I think all of the clearing banks and some of the other financial institutions did do that. Okay, however, be careful that once you've reached the decision that there ain't no way that you can ease this burden, do not delay the inevitable. That means calling in the loan, realizing any collateral security, assessing the client's financial assets, looking at their net worth to see if the loan is unsecured or not fully secured. Look at their statement of affairs. You would want to call them in, get an updated statement of affairs, see where they stand, and look at that to see, if there's any way you can, based on their assets, that you could go after any assets they may have to get your money back. Okay, so that is the cannot pay person. If you have the will not pay person, and you'll see that this is in big print, don't waste your time. Proceed to collect. Okay, the person who ain't paying in the past, if they probably only use hard times. Like if they wasn't paying before COVID, okay, they was using they use COVID as an excuse, but they wasn't even paying before COVID. So there are people during COVID time, I ain't check for them. Okay, give me my car, give me my furniture, give me my house. Too bad. Okay, because you showed me you will not pay. So I'm wasting time with you. My time on those people who was paying in the past, they now have a problem. I can spend my time working with them, or at least I can focus on them first. Okay. It may seem harsh, but that's the reality of life. Okay. And they brought it on themselves. It's almost like the boy who cried wolf. When a wolf actually came, people didn't pay attention to him because he was, lying. All right. So, determining the appropriate strategy, trying to find a workout solution for your client. Okay. So when we're dealing with workouts, Again, this portion is not in your books, but it's you'll get the PowerPoint presentation to help you. Okay, so when you're dealing with working out or loan workouts, you're looking at rehabilitating or restructuring a problem loan. Okay, so you want to rehabilitate or defer. Okay, that is, and this is a short-term thing. This is a temporary fix, and the goal is to quote unquote stop the bleeding, so to speak. Okay, so for example, if you could do, if the client doesn't have the full payment, but they can meet a lower payment, you take the lower payment from them. So it may be, you may have to take only interest-only payments, or you may say, okay, what we'll do is we'll not take payments for the next 2 or 3 months. Let's see how it goes, and then we'll revisit it, the situation again. Okay, so you look at working with the client, or the client may say, you know, I may be able to pay $100 this month or $20 next month or whatever it is. So you may agree to accept whatever amount they bring. Okay, so that is a workout situation, a short term. Okay, and the goal is to stop the bleeding, because what you want to do is you want to accept something, because interest is continuing to accrue on whatever facility that is, and you don't want the client at the end of the day to have a whole bunch of interest if this is a good paying class customer in the past who is now on hard times. Okay, so restructure or modification is a long-term fix, but that will not happen until there is some stability in the payment. So for example, if the customer was making a $500 payment before, but they can only make $300 now, and they've made that $300 for the last, say, 3 or 6 months, you may want to look at restructuring the loan for the $300 payment, which may mean you may have to extend the term of the loan. Okay, and you know, when if they get back on their feet and they could afford the $600 payment once again, then you know, that'll shorten. Then you find you shorten the loan term closer to what it originally was. Okay, so the workout, you either rehabilitate or defer, or you restructure, modify. One is short term and one is long term. Okay, and the workout, we call that the carrot. Okay, using the carrot. Okay, the second option is liquidation. Okay, and we refer to this as a stick, the carrot or the stick. You may have heard those sayings, the carrot or the stick. Okay, so liquidation is recovery, either by realizing the collateral security or via any other assets that the borrower or the guarantor has. So again, we will know what the borrower or guarantor has, because without letting them know that, tipping them off as to what we are, you know, you want to call them and, hey, you're having some difficulty, coming, let's talk about it. And you know, while you're here, hey, let's complete an updated statement of affairs, see where we can assist you. And part of getting that updated statement of affairs, again, is to see what they own and what they owe. And you want to look, focusing on any assets they may have that you could levy against in getting your loan liquidated. Okay. So in this liquidation, you want to consider some remedies. Again, this is not in your book, so you're not required to know this for the exam, but it is for your personal knowledge, okay, and benefit. So you want to consider the various remedies. What I've done is I like how we use Campari to help us to remember. You use it as an acronym. Well, in the various remedies, we've used an acronym called SAFES, S-A-F-E-S, SAFES. So the first S, the beginning S, is sell, and you can do that 2 ways. Either voluntary by the debtor, you allow the debtor to sell the asset that is pledged to the bank, whether that is the car or furniture or the real estate. So you allow them, and you'll do this for customers who you trust and who've been good payers. So you allow them to the first option to sell the asset, or you yourself can sell via your power of sale. And the power of sale will take place either via public tender, which is usually for standard mortgages, or public auction, which is usually the method for government guaranteed mortgages. Okay, or public auction will also be used in the next section where receivership. So if you have to appoint a receiver, that is the A, appoint a receiver. The person doing the receiver who is appointed will, if they have to sell any of the assets of the person or well, this is for business. Appointed receiver, this is for businesses. They would sell it by public auction. Okay, so you can appoint a receiver, and the business goes into receivership, and that receiver, if the business is worth continuing, the receiver will decide whether or not they will either wind up the business or they'll continue the business and generate income. Okay, foreclosure is normally stayed away from in the Bahamas, but it is still an option that can be the bank can go after. The foreclosure involves negating any claim by the lender if you sell a property less than the value of that property, right? Or that they will not get anything, even if there's a residue left after the asset has been sold. Foreclosure, again, because of common laws and also the Homeowners Protection Act, which covers most of the mortgages in the country, foreclosure is kind of almost nullified. But it doesn't mean that there may be cases where a bank can do a foreclosure in the Bahamas. Okay. Then there's enter into possession. Okay. But first of all, the bank must exercise its power of sale and to sell. Okay, that's option B, by lender, by power of sale. So what you'll find is the bank will probably go to the courts to get their power of sale effected by the courts, and also they will ask for vacant possession to be able to exercise vacant possession at the same time. So rather than having to go to the courts for power of sale and then go back, spend some more legal money or legal fees to enter into to get vacant possession, the bank will just go one time for the whole kit and caboodle, exercise their power of sale and enter into possession. The thing with entering, once you exercise your rights to enter into possession as a bank, you are responsible for that property. Okay, so you are responsible for the insurance, for the upkeep, making sure it's protected during insurance, during hurricane times, it's not vandalized. And so you'll find that unless a financial institution has a pending sale for property, or if there's maybe some other reason that they want the occupants of the property out, they will wait almost till the last minute to enter into possession. Okay, so if they find that for example, if they find that the people who occupy the property are deliberately vandalizing the property or whatnot, in order to avoid any further deterioration of property, they may enter into possession, kick the people out in order to preserve the existing value of the real estate. Okay, and then the second or last letter, sue on covenant to repay. they can go after the any legal person, and that is an individual or a company. An individual could be the borrower or the guarantor. Okay, so if at the end of the day they have not realized sufficient funds to clear a debt, they can go and sue the customer or the parties who are obligated under the covenant to repay. Okay, so they have sell, appoint a receiver, foreclosure, enter possession, sue on covenant to repay. Any questions on that?
No, sir.
Okay. So let's look at timelines for action, and then we look at judgment. Okay. Okay, so timelines for action. Okay, so that'll be on the bottom of page 65. So it says that delinquency must be caught within the first 5 days to avoid further deterioration. If you wait longer than 5 days, it becomes more and more difficult to get your payment. Okay, so here we have this timeline for various actions chart, and so we have the action, and then in each we have in days. So in the first 1 to 5 days, it says determine if the problem is either internal or external. If internal, resolve immediately. If external, call the client. By day 6, between day 6 and day 29, you want to follow up with the client via phone call for the promised payment, or via letter or email. Okay, and you know we also have other social media. So we have Facebook, Twitter, LinkedIn. So if you don't have the email, you might want to go search on LinkedIn and other social platforms, Facebook, etc., to see if the client pops up and contact them via there. Okay, 30 to 59 days, you have to do a further follow-up with the client, and then if necessary, you do a site visit. If it's too dangerous, you accompany yourself with a police officer, a law enforcement officer, or officers. 60 to 89 days, that's when you issue your written demand for payment. And most banks have a standard letter for writing for demand of payments. And then, of course, when it goes into non-performing, that is 4 payments or more in arrears at 90 days, you do written final formal demand for full repayment of the debt. Okay. And if you get no action, then you may have to consider exercising one of those options that we looked at by the courts for safes. Okay. So talking about the courts, let's look at the makeup of the court. Okay. So the top court in the jurisdiction of the top court covering the jurisdiction of the Bahamas is a Privy Council, which is located in the UK. Okay, so the Privy Council is the highest court that you can appeal to within the Bahamas. Okay, but again, the Privy Council is located in the United Kingdom. The highest court here in the Bahamas is the Court of Appeal. Okay, under that is the Supreme Court, and they deal with any claims of $5,000 and over, or I should say over $5,000. And then, of course, you have the magistrates' courts for any claims up to $5,000. So if the debt the customer has with you is up to $5,000, you can go to the magistrate's court, which is not as expensive as going through the Supreme Court where the claims are over $5,000. The difference between the magistrate's court and the Supreme Court is that the magistrate's court, the only recourse they have to the Court of Appeal is not for monetary or financial offenses, okay, such as, so for example, if the court rules against the bank, unfavorably against the bank, and it's for a claim up to $5,000, you cannot go to the Court of Appeal. Likewise, if it rules against the client cannot go to the Court of Appeal, because the Court of Appeal will only hear cases from the magistrate's court for indictable offenses. So indictable offenses would be stealing, murder, rape, those types of things. But anything to deal with finances, owing bank money, financial institutions money, that's not a case that can be appealed to the Court of Appeal. Okay, the Supreme Court is where you can appeal financial cases as well as indictable offenses. Okay. Now, let me just refer to your book, page 66. Unless I'll just read that section on judgments. A judgment is issued by the courts against the defendant for the value of the matter heard by the court. This could create difficulties with the individual securing a mortgage, purchasing property, selling a property, inheriting a property, or willing a property to their estate. Such judgments are uncovered during title searches, and the purchaser of the property cannot obtain clear title unless the judgment is settled. That is a judgment against the purchaser. Hence, the previous borrower or their estate will have to settle the outstanding judgment before the property can change hands. The real estate transaction can only proceed if the judgment plus any accrued interest is settled as well. The lender could reserve the right to withdraw the earlier approval. So if the lender had, if you had approved a loan based on taking a mortgage over a property over which there's a judgment, you could withdraw your approval, or if it's found out that the person who, your borrower, your lender, has a judgment against him or her, you could withdraw your approval. Okay. It says NB, note well, judgments do not expire. Okay, that has changed. Okay, the homeowners Protection Act, I think it's 2017, that changed back in 2017, late 2017, the end of 2017. I think it's December 2017 or thereabouts, which was a few months after this book was printed. Okay, so again, this particular book has not been updated, but you need to update it. So judgments do expire. Okay.
Mr. Nordage.
Hello?
Yes, Mr. Nordage. You want to go into that a little bit for me, please? You said the Homeowners Act of 2017.
Yes, the Homeowners Protection Act. With that, there was some other changes in laws with regard to judgments, because judgments didn't expire, and I'm going to get into that in a minute. Okay, so so just hold the put a pin there for the time being, because I will come back to that. Okay, but I want to get into, since we're talking about courts, talk about considering the various costs. when you're going to be making a decision whether or not to pursue action against a client. Okay, so are you going to carry the loan or continue to carry the loan, or are you going to pursue action to recover and any costs associated with each of those actions? Okay, the cost of carrying the loan versus the cost of pursuing legal action to recover your funds. Okay, at the end of the day, what is the bank's overall cost or loss? Okay, so you need to look at opportunity costs. Okay, opportunity costs, for example, what are the pros and cons of taking action now as opposed to delaying? Okay, if you delay, you run the risk of your judgment being statute barred, or your ability to collect your debt because it's statute barred. And again, we're going to be looking at how a payment can be statute barred, or what they call the outlawry date expiring, right? So opportunity costs. The opportunity costs also involve, this property is worth $100,000, but we can only get $60,000 for it, or should we hold out to see if we get 75 for it, and then only to find out the property deteriorate, and at the end of the day, you only got $50,000 for it. So you have to make a decision whether or not you move now or later. Okay, so those are your opportunity costs. Then of course there's a legal and administrative costs, and in the next slide we'll look at some of those legal costs with regard to pursuing either through the magistrate's court or through the Supreme Court. So you want to consider your costs. And one of the things you want to do is it worthwhile me taking this to court? So for example, even if it's $6,000, okay, it's not worth it me taking that to the Supreme Court, because I can only go up to $5,000 in the magistrate's court. But it might be worth my while, because the legal fees associated with me going to the magistrate's court and getting $5,000 is I'll take that $1,000 loss, as opposed to paying much higher legal fees to go after $6,000 and then end up being out, $3,000, because you had to spend an additional $2,000 in legal fees. So you're out the $1,000 that you would have lost anyway had you gone to the magistrate's court instead, and also the $2,000 you paid for the attorneys through going to the Supreme Court as opposed to going to the magistrate's court, where the legal fees tend to be less. Okay. Then there's also collateral cost considerations. Okay. So so you look at the cost of the collateral. Is this really worth us going after? Okay. This could probably be a case where the property was generational property and it only just came to light. You may say, okay, well, let's go after the lawyer who prepared the document and overlook this. But then if that lawyer only has, say, $50,000 indemnity, professional indemnity coverage, and you're looking at $100,000 or $250,000, you can't even go after the lawyer, because chances are they don't have the assets. Okay, so you need to is this worth it? Is this something we should just turn away from? Then of course there's market reputation costs. Okay, would our name as a financial institution be sullied by taking this particular action? So for example, you have someone who it was widely publicized that this person had cancer, and everybody, this is a well-liked person. Let's say this person played on a national baseball team. They came back, and after some time they became ill. They had cancer, and as a result, they couldn't pay their mortgage. Do you want to be seen as the bank that this person who played for the national team and did so well for the national team, and now has cancer, and on it, on their way out or whatever it is? Do you want to sully your reputation by being the bank that put this person out of their house, right? Or close their business down? So again, there are those considerations that you have to look at in making a decision. Okay, so opportunity costs, legal and administrative costs, collateral costs, and market reputation costs. So on the next slide, as I indicated, we look at the difference between the Magistrates Court and Supreme Court. And so these costs may have increased since then, but there's still that vast difference between them, notwithstanding that they have increased. So the Magistrates Court's claims not exceeding $5,000, the legal fees say between $500 to $700. Issuing a demand letter, $75. Single court appearance, $300. Extra costs for having the client's means examined. The hourly rate depends on the bar scale, and normally you wouldn't find your QCs going to the Magistrates Court, so you'll find few senior lawyers, but more your junior lawyers going to the Magistrates Court, because the hourly fee would be prohibitive for the bank. So you go into the Supreme Court, where the fees are anywhere between $1,500 to $1,700. In fact, I've heard a lot of lawyers that their base fee is $5,000. Okay, so going to the Supreme Court, so $5,000–$10,000 thereabouts. So it's not cheap going to the Supreme Court. And then, of course, there are extra costs of having the client's means examined. Okay, and unlike the Magistrates Court, which may take a single or two appearances, going to the Supreme Court may take 3 or more visits to the Supreme Court to get a matter resolved. So so you're looking at single court appearances based on the lawyer who's dealing with that, probably anywhere from $500 to $1,000 and up, again, based on the bar scale for that person's seniority. Right? So now let's go and look at these outlawry or statute bar dates. Okay. And this is where I asked, I think it was Kendrick, to put a pin in that thought. So, so the outlawry date or the statute bar date, this means that once this date has passed, you can't go after the client for that particular debt. Okay, so loans and overdrafts is 6 years from the last payment. Okay. So if you dilly-dally, and 6 years pass from the last time the client made a payment, you might as well write off that loan or write off that overdraft. Okay. The outlawry date or statute bar date on mortgages where good documentary title has been given by the attorney, it's 7 years after the date of the title has been issued, or 6 years after the last payment. Okay, so the second one, or 6 years after the last payment, is similar to loans and overdrafts. When it comes to judgments on over mortgages, the statute bar, they're statute barred after 6 years from the date of the judgment. Okay, and then you see a note there, prior to March 2017, judgments on mortgages did not expire. Okay, so prior to March 2017, judgments on mortgages did not expire. And that was because of some law changes and also the coming into effect of the Homeowners Protection Act, which affected mortgages on residences that were the people's actual residence. Okay, so that could be a single family home, or that could be a duplex or triplex. If it was owner occupied, it was covered under, it is covered under the Homeowners Protection Act. Okay, and under that, after 6 years of the judgment, if you do not exercise your right, which includes entering into protect, getting vacant possession, you cannot go after the clients anymore. Okay. However, if the client settles the debt, or the debt is settled by way of a sale of the asset, the judgment can be marked settled, and it can be marked settled, and that would take the client off the hook, going forward. Okay. Any questions? Any questions on that?
I got a question. I have a question, but it isn't related. It's related to it. To my understanding, let's say, for instance, a person has not made a payment within the 6 years, but still you reach out to them and they come in and they make a monetary payment of any sort. Doesn't that start the clock over?
Yes. Once a payment is made, it starts the clock. Yes.
Thank you. And in regards to the mortgages where the document, is this from the onset when they get the title?
Repeat that, because you're fading in and out. Repeat that last question.
I am looking at point number 2, mortgages.
Okay.
Can you explain that one again, please?
Okay. So where a mortgage was given and the attorney gave you issued you a certificate of title saying you have a good title. Okay, it's 7 years after the date of that title. Okay, the outlawry date. So you'll be able to go after you'll be able to go to the lawyer and say after 7 years and say, hey, we found that there was faulty, there was a faulty title. So you can go back to the lawyer and hold his or her feet, or the firm's feet to the fire.
Okay.
Okay. Other than that, for loans, overdrafts, well, I should say consumer loans, overdrafts, and it would extend the credit cards as well, and judgments, mortgages, apart from that caveat with the documentary title being given by the attorney, judgments expire. It is one thing for all of them. They expire after 6 years. On that six year, when that 6 year comes around, that expired that 6 year. After that, going into day 1 of year 7, bam, you can't go after the client. Okay.
Yes, sir. Thank you.
So it was regularized because in the past, judgments didn't expire. They follow you to your grave and beyond. Now what will happen is if a judgment expires, it'll still show up on that for that client that it expired. It was not settled or satisfied. The debt was not satisfied or settled. Okay, so for example, for the credit bureau, for that person, it'll still show that they had a judgment against them that expired. It won't show them that there's a judgment that was settled or satisfied. And there's a distinct difference because if someone has a satisfied or settled debt, I am more likely to look at them favorably for additional financing as opposed to someone where it just simply expired. You understand what I'm saying?
Yes, sir.
Okay. So, any questions come to mind on anything tonight or previously? Because that's the end of chapter 11. If no questions, like I said, on Tuesday's class, if I've gotten confirmation about the VAT on real estate sales, I will look at that first, and then I'll look at oh yeah, I have an announcement there. If not, I'll go into chapter 18. We look at chapter 18. Okay. Now let me just make this announcement here. I was unable to get my printer up and running to scan. So the last 2 sets of homework, I was able to scan and send it to you. That's why you haven't gotten the actual scripts. So I've packaged them and I will drop them off to the Institute tomorrow morning. So you may want to actually look at those in terms of helping you, assisting you with your studying. Okay, so you may collect those. There'll be 2 scripts for the last 2 homeworks in the envelope with your names on it at the Institute. So I'll drop them off tomorrow morning. I can safely after 10 tomorrow morning, you should be able to collect them from Biff's office. Okay. And as I mentioned earlier, chapter 18 will be the last chapter we look at, mechanism used to facilitate international trade. We look at that on Tuesday, which is our last teaching class. Okay. Because next Thursday will be our review class. Okay. And then,
Yes,
of
sir.
course, after this class, I'll send homework assignment, and also for Daniel, I'll send the missing pages for, I think, pages 60 to 73. Okay. And if there are no other questions of any sort related to the course, or comments or whatever, that's it for the night.
Okay, sir. Thank you.
Okay, thank you all for your attention, and see you all on Tuesday.
Good night.
Good night.
Good night.